On July 31, 2026, a photograph from a Camp David cabinet meeting changed the global currency game. Treasury Secretary Bessent's notebook, captured by a White House photographer, appeared to read, "Purchase $5 to $10 billion yen." It was the first time in 28 years the US directly intervened to support the yen. But this was not charity. It was a defensive move to protect the US Treasury market and the AI-driven carry trade. In the next 14 minutes, we'll trace the 41-year pattern of US-Japan interventions, decode the hidden mechanics, and explain why gold, despite short-term pain, is the long-term winner. By late July 2026, the yen had fallen to 164 per dollar, a 40-year low. The last time it traded at that level was 1986, the year the Plaza Accords effects began to unwind. For hedge funds, shorting the yen was the most crowded trade of 2026. The logic was simple: Japan's interest rates were near zero, while the Fed's were above 5%. The carry trade, borrow yen, buy higher-yielding assets, seemed risk-free. But on July 30th, a sudden candlestick crashed through 160, hitting 158 in minutes. The market assumed Japan was intervening alone, as it had in April and May, when it spent 11.7 trillion yen to little effect. The leaked notebook was no accident. Bessent is a veteran FX trader who made over $1 billion shorting the yen in 2012 with Soros. He knows exactly when a camera can capture his notes. The message to hedge funds was clear: the US Treasury's Exchange Stabilization Fund, the New York Fed's open market account, and its FX desk are all behind the yen. Within hours, Bessent added 3 public statements: the yen is undervalued, the US has conducted an FX check and intervened, and more intervention is possible if needed. An FX check is a quiet phone call from the New York Fed to major banks, asking for quotes, without placing orders. It's a threat, not a trade. A crucial detail: the US bought yen by selling euros, not dollars. Why? Selling dollars would increase the dollar supply and hammer the dollar index. The euro channel supports the yen while minimizing damage to the dollar. This is the muscle memory of a seasoned FX trader, not a bureaucrat. Meanwhile, the Bank of Japan held rates at 1% but signaled a hike this fall. The governor said core inflation would exceed 2% in the second half. South Korea joined in, confirming coordination. Within 3 days, the US, Japan, and South Korea spent over $60 billion to push the yen from 164 to 156. This was the first US intervention since 1998. This is the 5th US-Japan joint intervention in 41 years. Each one occurred when a system felt out of control. In 1985, the Plaza Accord devalued the dollar to save US manufacturing, but it crushed Japan's export competitiveness and fueled a bubble that led to the lost decade. In 1998, after Soros attacked Asian currencies, the US and Japan bought yen to stabilize the region. In 2011, after the earthquake, G7 sold yen to help Japan. In October 2011, Japan acted alone during the euro crisis. Now, in 2026, the US is directly involved, not just morally supporting, because the threat is to the US itself. The answer lies in Davos, January 2026. Bessent reportedly scolded Japan's finance minister: Japan must stop any operations that could disrupt the US Treasury market. Japan is the largest foreign holder of US treasuries. To fund yen intervention, Japan would sell treasuries. With US long-term yields already at post-crisis highs and the Fed under pressure, a Japanese sell-off could spike yields and raise government borrowing costs. So the US is not saving Japan, it's saving its own debt market. This is the first layer of fear. The second is the carry trade. If the yen surges, leveraged investors face margin calls and sell everything, including US tech stocks. The third is the system itself. The carry trade's profit depends on the interest rate differential and the exchange rate. If the yen appreciates, the trader loses on both fronts. The formula shows the total return in dollar terms: the interest earned on the high-yield asset minus the interest paid on the yen loan, plus the percentage change in the exchange rate. When the yen strengthens, the exchange rate term becomes negative, and losses can exceed the interest gain. With leverage, the impact multiplies. A 3% yen move on a 10x leveraged position is a 30% loss on equity, enough to trigger margin calls and forced selling. The deepest fear is the global debt pile. As of Q1 2026, global debt reached $353 trillion, over 3 times world GDP. Government debt's share hit a record 30 to 31%. This is a trust game. As long as everyone believes the system will hold, it does. But when the world's 2 largest economies must use extraordinary measures to support a currency, it signals cracks. Every step, the leaked note, the FX check, the Euro channel, reveals that policymakers are running out of conventional tools. The fiat system's credibility is being eroded by the sheer size of debt. On July 31st, as the yen surged, gold fell. Why? Because leveraged investors who had borrowed yen to buy gold and tech stocks faced margin calls. They sold whatever was liquid, and gold, with its high liquidity and fat profits, was the first to go. This is the unwind effect. Additionally, with US real yields near 5.5%, gold's zero-yield disadvantage becomes acute. When you can earn 5% risk-free, holding a metal that pays nothing is less attractive. So in the short term, intervention triggers a gold sell-off, a liquidity squeeze, not a fundamental change. Gold's opportunity cost is the real yield on treasuries. When real yields rise, gold becomes less attractive. The formula shows the real yield as the nominal yield minus expected inflation. If the Fed cuts rates or inflation rises, real yields fall, boosting gold. The intervention's effect on gold is therefore indirect. It affects yields and the dollar. In the long run, if the intervention signals that central banks are desperate, it undermines confidence in fiat, which is bullish for gold. Despite the short-term sell-off, central banks have been buying gold at a record pace. Over the past 4 years, they averaged about 1,000 tons annually, double the previous decade's 500 tons. In Q1 2026, they bought 244 tons even as Western gold ETFs saw outflows. China and Hong Kong ETFs attracted $9.7 billion, about 58 tons. Why? Because financial sanctions have shown that dollar assets can be frozen. Gold is not anyone's liability, it cannot be sanctioned. This structural shift is a long-term bullish force. The gold-to-copper ratio measures gold's price relative to industrial copper. When this ratio rises, it suggests gold is being driven by monetary fear, not industrial demand. From 0.25 in 2023 to 0.38 in H1 2026, the ratio has climbed sharply. This indicates that gold's rally is not about electronics or construction, it's about currency debasement. The formula is simple: gold price divided by copper price. A rising ratio means gold is outperforming the real economy. The intervention reveals that central banks have exhausted conventional tools. If higher rates worked, they wouldn't need FX intervention. If intervention worked, they wouldn't need to leak threats. This escalation is a sign of desperation. Analysts maintain gold targets of $4,000 to $4,500 for 2026, with some seeing $4,750 to $5,500. In extreme scenarios, if the Fed is forced to cut, the dollar weakens, or geopolitics spirals, gold could reach $6,000. The short-term pain is a liquidity squeeze, the long-term gain is a structural shift in reserve assets. In 1985, after the Plaza Accord, Japan's finance minister smiled and said, "We'll see." That confidence was misplaced. The yen's doubling crushed exporters, and the subsequent bubble and crash defined Japan's lost decades. In 2026, Japan's finance minister, confirming the joint intervention, sounded exhausted: "We will continue." The difference is stark. In 1985, the US was confident, Japan was reluctant. In 2026, the US is fearful, Japan is desperate. The same action, 41 years apart, reveals the shifting balance of power and the fragility of the system. The US is not saving Japan, it's saving itself. The intervention protects the Treasury market and the AI-driven carry trade. It exposes the cracks in the fiat system, where $353 trillion in debt requires extraordinary measures to maintain confidence. Gold, the perennial victim of liquidity squeezes, is the ultimate beneficiary. Every time it's sold to meet margin calls, it's bought by central banks seeking safety. The lesson is clear: when the paper system burns, only assets that are not someone else's liability hold value. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.